Thanks very much for everyone who's here. It's a very good gathering, and I think it's really begun very well with the alpha launch of Crown. That was what a great thing to show you. The first panel of today is about the board, since the theme of today is the centrality of the board to governance and how the Millstein Center is going to focus on that. I want to make, by way of sort of a setup, three specific points. First is that the activism we see is really reflective of the triumph of the Delaware model that puts the board at the center of governance. So I think Delaware really should celebrate the rise of the activism of the day and protect it, because it puts the board, not the hostile takeover, but the board at the center of the governance drama, and reasserts the centrality of the election, the proxy battle, as the main vehicle for board accountability. The second claim is that what the new form of the activism shows us is that the board needs to evolve, and that that's a good thing. The current model of the board, which consists really of outside directors who are part-timers in their role, who monitor, quote unquote, but do not manage, that's an invention of legal academics writing in the 1970s. They're good things, they're strong things, they're weak things about the model. The point is, it was and is an experiment in design. It's not from Sinai. I think what the present wave shows us is that a rethink is in order. The third claim is that the short-termism, the long-termism debate it's a symptom. It's not a cause. It shows us that for the large public firm, we do not have a monitoring device that can credibly claim that management strategy is indeed the wisest course of action for the creation of shareholder value over the long term. Managements are prone to long-termism as well as short-termism. The present governance setup is often unable to provide credible reassurance to the owners, to the institutional investors, to distinguish the two. And so the right response is not to bemoan this change, but rather governance innovation, which brings us back to the board, as well as appreciation that the governance needs of the firm will vary in the cross-section, so that we should expect differences across firms and differences over time. So we need to think about how to avoid the lock-in of a governance structure that might be exactly the right one for this moment, but not a good adaptation for a later moment. So I want to come back to point two, which is the nature of the monitoring board and the limitations of it. So the issue with the monitoring board is that the directors, the new directors, were outsiders from an information point of view. How could they monitor the management team without deep knowledge of the firm and the business environment in which it sat? The stock market actually provided the answer through the production of informative stock prices that would impound the available information about the firm as well as its competitors, aided by an increasingly full and rich SEC disclosure regime. And so the stock prices based on that could significantly overcome the information gap that the directors had, because they provided a basis for a year-against-year performance comparison and comparison against firms in the same business. And plus you tie compensation to stock prices, and this was the way we would monitor the managerial team. But notice, of course, that stock prices are limited. not only the information about the firm's future direction, which might not be already revealed, because after all, it would disclose that to competitors, but also stock markets are not perfect, you might say. But still, the monitoring model we had, given the shareholders of the time who were dispersed, was a significant improvement over the inside monitoring model, or lack of monitoring model, that we had before. But think about 2015 and how the ownership patterns have changed. The fact that we can, in a really credible way, get the owners of many large firms around a table not much bigger than the ones you're sitting at. And think about how that governance model is not well suited. So a governance structure, a governance model that's premised on thinly informed directors, because that's what we have, leaves firms exposed to the hedge fund attack. Think about it from the point of view of the institutional owners considering the claim, the hedge fund claim. Ex ante, the hedge fund should be unbiased. It makes a toehold investment and starts the campaign only if it believes the firm is mismanaged, either in a financial or strategic sense. Why is that? Because the hedge fund, in effect, is an asset manager whose business depends upon repeated success over time. It earns returns from appreciation in stock ownership. Its ability to credibly deliver positive returns, A, is important to generating funds from the outside investors in the next period, and B, to sustaining credibility with the institutional investors whose support that it needs for any campaign that it offers to be successful. So in a sense, its effort is to gain a credibility with the institutional owners that its plans will bring strategic improvement in the firm. All right, so they're unbiased in the sense that I'm describing. The pitch, on the other hand, that the institutional investors see is from management, which is by definition biased. And so how are the new owners supposed to resolve the dispute? Because after all, they probably start off by favoring the management team, because even in an indexed environment, you're looking to the activist managers in the group for guidance as to how to vote the shares. And presumably they invested in the firm because they believe in the management team. So they start off believing that management is right. Nevertheless, the hedge fund comes with a thick deck of slides with a reasonable business cases, how to improve value. Who is the institutional owner supposed to look to? Under the present board model, the institutional investor cannot look to the thinly informed director to help adjudicate this dispute. That's the point. The directors don't have the clout because they aren't put there to know enough to be able to say, we've really thought about it, and actually the management team, the strategy that the current board has or the current firm has is the better strategy. So, on this view, this leads to a new role for the board, credibly verifying that management's strategy is best for the firm. Boards need directors with that credibility who are not surprised by what's in the hedge fund slide deck, but who indeed know more than what's in it. It means directors tasked in a different way. We need directors who will be thickly informed, who have a different sense of expectation is about their role on the board of directors. So again, I want to come back to the notion that what we have is a diagnosis in search of a solution. The same institutional investors who supposedly vote for the short term also invest in VC firms, in PE firms, in blind pools, in effect, which is the very definition of long-term investing. Why do they do it? Because they believe in the governance model. And that's the point. The evidence that we now have before us is not that the hedge funds are good or bad, it's that there's a diagnostic issue that they bring to bear, which is that the governance model of a large public firm needs renovation. We need a high-powered board, I think, is part of the solution to that, and that's the intro for the next panel.